Warner Brothers Discovery, ticker symbol WBD, recently spun off from AT&T's business, and they've historically performed well, at least in the movie and entertainment business. But what about their stock? And should we be buying into the future of WBD while they're still at a PE ratio of about 8 and a market cap of $42 billion, making this technically a cheap stock? Stick around to find out as we talk about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we're going to analyze WBD's business and earnings results. We'll start with the full analysis of the financials, the top line, the bottom line, the balance sheet, the cash flows, and finally we'll conclude with a valuation of this business using our intrinsic value calculator, which will identify whether WBD is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be analyzing this business in 5 minutes, so let's jump into it. So Warner Brothers, an American multinational mass media and entertainment conglomerate, what are they focused on? And this is a note right from the CEO himself, and it is that they intend to maximize the value of the content that they have produced over time to a broad distribution channel that includes theatrical, streaming, linear cable, free-to-air gaming, etc., across the world, and that they're confident that they can meet their strategic goals and really excel creatively and financially. But what exactly does that mean? Well, as you can see here, the company is exploring the opportunity for a fast streaming service, free ad-supported TV, and they believe that they can create the most compelling and diverse content offering in the world. Additionally, their other focus is to repay the big debt pile that they do have on the balance sheet, which we'll get into in just a second. They also plan to launch a combined service with HBO Max and Discovery Plus, which they plan to launch next summer. All right, so that is the focus right now for WBD. What are they doing with the financials? And as you can see, they came in with revenues of $9.8 billion, a decrease year over year of 1%, excluding Forex. Additionally, they had 92 million subscribers for their direct-to-consumer business. This is actually an increase of 1.7 million users over the quarter. And so how does Warner Brothers break down their revenue segments? Well, they have a studio segment, which as you can see, their studios are listed here. They also have a network segment. This is where they bring in revenue from the most popular TV networks across the world. And then finally, they have their direct-to-consumer segment. This is where they host HBO and HBO Max, as well as Discovery Plus. So with that, let's jump into the numbers here. And as you can see, total revenues came out at $9.8 billion, which we discussed. But here's the issue, which starts off with their cost of revenues of $6.6 billion. This eats up a ton of revenues right away. We haven't even got to our expenses yet. When we account for SG&A, restructuring, and other expenses, we're already at total costs and expenses of about $13.4 billion on the revenues of less than $10 billion. As you can see, this is why this is getting bad. However, restructuring and other charges should be one-time costs. And actually, if you look at this from a year-over-year perspective, they only had about $7 million in charges last year. This year, it's over $1 billion. So as you can see, it's a little bit wonky here. And that's the reason why the numbers are looking pretty bad, especially when you compare it year over year. So anyways, that leads us to our operating loss of $3.6 billion. We deduct for our other expenses and unrealized losses and gains, and we're left with a net loss figure here of $3.4 billion. Now onto the balance sheet here, we have cash of about $2.5 billion, and we have debt here of $51 billion, not including the current portion of debt that's due within the next year. So the liquidity here looks really, really poor. And if we look at our total assets altogether, yeah, we're at $142 billion. However, they say that their content is worth about $30 billion, goodwill of $34 billion, and then finally they have $48 billion, let's call it $50 billion of intangible assets. So again, it's really hard to actually measure what their assets are truly worth. But as they have stated, and as we discussed earlier, taking on that debt pile is a big part of their plans for the future of this business. But with that, let's look through our cash flow statement here. We have $2.9 billion in net loss for the 6 months of 2022. Add back in depreciation, amortization, our non-cash costs, and our content impairments. And we're left with about $1.3 billion in operating free cash flow for the 6 months. Now we deduct our $300 million in capex, so we're left with about $1 billion, let's say, in free cash flow to reward shareholders for the first half of the year. What did they do with that? Well, they actually just went straight ahead and paid down some debt, as you can see here. So clearly that is their focus. They're not focused on repurchasing shares, nothing like that. They are simply focused on getting that debt figure down because they know that's the first thing investors are going to be looking at, and it can be a cause for concern. Now, before we jump into the calculator here, let's actually look at what WBD mentions about their liquidity issues. And as you can see, the average duration of debt maturity is about 14 years, which is actually pretty decent. So they do have a decent amount of time to pay off their loans, and their average cost of debt is about 4.2%. So as long as they can reinvest their money money at a higher rate than 4.2%, the debt shouldn't be too big of a concern for them. All right, so when it comes to our calculator, we need to know what kind of earnings per share figure to put into the calculator to accurately assess this company. And if we take an average, analysts are expecting that they'll come out with about 43 cents in earnings per share for the end of 2022. And then after 2022 into 2023 and all the way to 2026, we're going to actually see some substantial growth. So if we come over here to our calculator here and estimate that they can make about 50 cents in earnings for this year, we require a 10% return. They do not pay a dividend. And let's assume that for the first 5 years here, they can grow at 10%. And then once the debt slowly becomes less and less of an issue, they can continue to grow, invest more into the business instead of into the debt. And we can get to a growth rate of 15% on a 20 PE. The stock would be worth about $12 per share. Now the stock is currently sitting at $17.50. So let's try to be a little more optimistic with this. Let's say we can actually get to a point where we're actually growing at 25% per year. And again, 20% for the 5 years after. On a 25 PE, the stock would be worth $33. Now that's about a double from where we are currently. That looks really good if we can actually get to those metrics. And if it's in the worst case scenario, we're not able to grow, the debt becomes too much of an issue, on a 15 PE, the stock will be worth a measly $3. But again, this is in the very worst case scenario. And actually, if we take a look down here, we can see the stock is actually trading at its book value. But again, it's a little difficult to actually measure how much equity is really lying in the business when they have a huge portion of their assets as content, goodwill, and intangible assets. So for WBD, which is actually down 11% after hours because the Wall Street clearly did not like their earnings report, the risk to reward is pretty simple with this one. I think it's actually not too bad of a business. They do produce really good movies that bring viewership to box offices on a consistent basis, but they do have a substantial amount of debt, and they're entering into the streaming competition. And as you know, we have Disney, Amazon Prime, Netflix that they're all competing with for the same viewership. So this is the reason why for right now, I am hands off Warner Brothers right now. I want to see what happens over the next few quarters. If you plan on investing in this business, please do your own due diligence. If you enjoyed the analysis and the value investing perspective, please leave a like and subscribe, and I'll catch you on the next one.